Today, in under 20 minutes, I will provide you what you need to know if you want to invest in Chipotle. Trading near 32 per share, I currently have a buy rating on Chipotle stock, but there are several key factors that have a major impact on this thesis that I'll go deeper on. I will give you the positives and negatives from the 3Q results, a breakdown of the three financial statements and my Wall Street valuation model, what other analysts on Wall Street say about Chipotle, and my conclusion about Chipotle's future and what you should do. So why should you listen to me? My name is Ken Freeman. I'm a CFA charter holder. I'm also a professor of finance and economics. I have 20 years of Wall Street experience, and I'm the guy that investment banks like JP Morgan and asset managers like BlackRock hire to train their financial analysts on Wall Street. In my research, I discovered 6 things that got me very excited and 6 red flags to watch out for with Chipotle. If you're enjoying this, please smash that like button. Chipotle beat on earnings, but they lagged slightly on revenues. The stock got hammered as the company cut its forecast for same-store sales.
Let's start.
Let's cover the red flags first. When the 25 to 35-year-old, less than 100,000 in income group reduces visits, both volume and pricing power take a hit. Fewer transactions across the base means same-store sales go negative. That kills the growth story.
Yeah, I think looking at this one, I think people were looking potentially for traffic to be down. It was down about 1% on a comparable transaction basis. We've seen a little bit of this, pretty much from July through September and into October. October is a little bit more of a rebound so far, but the months of July through September for a lot of the fast casual chains has been a tough period. Again, we see this trend of that middle income consumer maybe finding alternative places for lunch and dinner.
Wage inflation is eroding restaurant level margins faster than revenue can recover. California's $20 per hour minimum wage hits profits in one of Chipotle's biggest markets. Management admits it might not be able to pass these costs on to customers without losing them. Rising chicken and beef costs plus tariffs make every burrito less profitable. When cost inflation combines with weak traffic, menu price hikes stop working.
As we look towards 2026, we see inflation growing as high as mid-single digits, which is a bit alarming for the industry in general. We will take a very conservative, measured approach to pricing. I don't think we can fully offset that inflation in the coming years, which will clearly put pressure on margins, but we believe it's the right thing to do for the Chipotle consumer.
Most of the revenue increase came from slightly higher checks, while traffic actually declined. This means that growth depends on squeezing more dollars from fewer people, a fragile strategy if wallets tighten.
Earlier, they projected that performance would be flat, by the way. In the third quarter, comp sales rising slightly, but it also fell short of Wall Street expectations.
Outsourcing delivery means Chipotle doesn't control customer experience or rising platform fees. If partners like DoorDash or Uber Eats change terms, Chipotle's margins and reputation take the hit. If you're paying more to advertise and traffic is still down, the brand is losing pull with the core customer. If higher marketing spend doesn't reverse traffic decline, profitability and growth might be at risk.
So if it is affordability, I think they should be able to address that rather quickly with some unique and different advertisements and marketing. We did a lot of work on this over the summer. We found you really can get an entire meal there for around $10 if you don't order the guac. On average, a chicken bowl is around $10.
Good news?
Here's what got me really excited. Solid top-line growth shows Chipotle's brand strength and pricing flexibility. It means the business is still expanding, while many restaurant peers are contracting.
Potentially kind of hit their tipping point with prices and finding ways to change their behavior on that front. So I think looking at the numbers here, I do think we see a bit of that. Now, again, I'll turn the page to October. They've had a little bit better month behind some of the Halloween promotions that they're running right now. But I think right now we're seeing the impact of a lot of competition, a lot of changes in behavior among that middle income consumer. And so I think that's what we see in the results more than anything else.
Even with inflation and wage pressure, Chipotle's store-level profitability remains strong. High margins give the company room to absorb costs and still grow earnings.
Restaurant margin about 24.5%. That's 1% lower than analyst estimates. It says due to higher beef and chicken costs along with the impact of tariffs.
Drive-through and pickup lanes improve convenience and throughput efficiency. Chipotle stores typically deliver stronger unit economics and higher margins. Catering is currently only 1 to 2% of sales, but scaling it could open a new revenue stream. Growing a segment with lower competition and high volume means untapped profit potential. Bringing back fan favorite items motivates lapsed customers to visit and uplifts brand excitement. High profile, limited time brand offerings can boost traffic and social media chatter without long term menu risk.
Another key component is the product innovation that we have launched around the adobo ranch, the red chimichurri, as well as carne asada, are proving to drive transaction uplift with that cohort as well. So I think menu innovation is going to be really critical to our 2026 strategy, which you'll see more of in the coming months.
This is what everyone is missing. Strong digital mix keeps revenue resilient even if in-person visits slow. Digital customers are typically more loyal and have higher average spend.
So I think that the aspects of the business this quarter will be how they're improving on operating leverage from drive-through business, digital sales, which are up 35%, as well as the same-store sales numbers, which are key for any retailer or restaurant for that matter.
When it comes to any stock, I let the numbers tell the story, and that involves looking at the company's financial statements. Would you buy a house without knowing the size, location, dimensions, or condition? That is exactly what you're doing when you buy a stock without understanding the 3 financial statements. If you want to see how I train the world's top financial analysts on Wall Street, check out my school community, Win Like Wall Street. Just scan the QR code on the screen. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases, and we win. Chipotle has nearly $780 million of cash, and it has grown 53% over the last 5 years. And the company has 0 debt. Tons of cash and no debt gives money for buybacks and expansion. Chipotle provides a product, so they need to be efficient at managing working capital, which is analyzed by looking at receivables, inventory, and payables, a metric known as cash conversion cycle. While rarely seen, Chipotle has a negative cash conversion cycle. They are receiving money from customers more than 2 weeks before paying it to suppliers, which gives the company incredible financial flexibility. Chipotle generates consistent and growing net income, and since they do not pay a dividend, retained earnings has grown substantially. Increasing retained earnings indicates that the core equity of the company is growing, which is a great sign for investors. So what's the takeaway? Nearly $1 billion of cash with 0 debt, world-class working capital management, and growing retained earnings gives us a pristine balance sheet for Chipotle. The income statement shows us if the company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profit is via margin. Revenues minus expenses equals income. Income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is what we want to see. Revenue growth has remained strong due to menu pricing, digital orders, and new restaurant openings. Multiple drivers, not just traffic, are fueling the top line. Operating and net margins have stayed solid and rank among the best in the restaurant industry. Because Chipotle has no debt, there's no interest drag. Margins flow straight to net income. Net income is growing at more than double the rate of revenues. Remember, revenue is what you make, net income is what you keep, and this is showing incredible operating efficiency. So what's the takeaway? Healthy double-digit top-line growth and increasing profitability. Chipotle is converting sales growth into earnings growth. The cash flow statement tells us where the cash is generated by the company, and there are 3 buckets. Operating, which is the cash the company generates internally. Investing, which is the cash demanded for long-term growth. Financing, which is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash making this positive, not losing cash, which would make this negative. Operating cash flow is positive and growing rapidly, primarily driven by the strong net income that Chipotle is generating. Because Chipotle has been disciplined with CapEx, free cash flow is growing rapidly, and this is the basis for our DCF valuation. Over the last 6 years, Chipotle has generated close to $3 billion from its invested cash, and it has used these proceeds to return cash to shareholders with $3.1 billion of share repurchases. They are literally taking the return from their invested cash, giving it to shareholders, and growing the principal. So what's the takeaway? Chipotle is self-sustaining, it doesn't need to tap debt or equity markets, and it invests its cash, returns the proceeds to investors with plenty left over. A well-run company. So what do I think about Chipotle and what should you do? I'll get into that, but first, let's go through my valuation. On Wall Street, we build a discounted cash flow model to measure the intrinsic value of companies. Because companies generate cash flow and we projected the 3 financial statements, we could take these future cash flows, discount them back to today to get a current intrinsic value for the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. As you can see on the left, we take specific line items that we projected from the 3 financial statements. We use these items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity, because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get to total enterprise value. To get to equity value, we strip out the debt, we add the cash, we strip out non-controlling interest, we add associate investments. We get an intrinsic equity value of $59.7 billion. We divide by the current shares outstanding, we get an implied share price of $45.17 compared to the recent close of $31.97. That's a 41.3% discount, which is a buy rating. On Wall Street, when a stock is trading at greater than a 20% discount, it's considered a buy because it provides us a margin of safety. I'll give you my take on how to play Chipotle stock later in the video. So what does Wall Street have to say about Chipotle? Let's cover that next. Wall Street consensus has Chipotle at a buy, but the biggest question is around their target market of 25 to 40-year-old consumers facing economic uncertainty. Mizuho has a neutral rating on Chipotle, and they cut their price target to 34 from 40. They cited an underwhelming Q3 and below expectations early 2026 commentary, which further undermines same-store sales and margin visibility near term. JP Morgan kept a neutral rating on Chipotle and cut the price target to 40 from 44. They say that limited visibility into a same-store sales recovery caps the valuation after the latest 2025 guide down, with traffic softness still the swing factor. KeyBank kept an overweight rating on Chipotle and trimmed their price target to 45 from 52. They noted sales and traffic challenges into the second half after the guidance reset, even after the firm stays positive on the name's structural strengths. CapIQ gives me a sense of how other analysts on Wall Street view the company. 33 analysts cover Chipotle on Wall Street. The target price ranges from a low of 34, which is a 6% increase, to a high of 55, which is a 72% increase. It's trading below the Wall Street low. The median is 45, which is a 41% increase. The overall rating on a scale of 1 to 5 is 1.69, which is an outperform rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
That being said, I currently do not have a position in Chipotle, but I'm keeping an eye on it since I think this is a great opportunity. If you decide to buy Chipotle and become a shareholder, I'll tell you exactly how to build a position, which I'll reveal shortly. Staying debt-free gives Chipotle flexibility in downturns and freedom to invest in growth. It reduces interest rate exposure while competitors carry leverage risk. Management is still actively sending cash back to investors, which supports shareholder returns long term. Buying back shares at depressed prices boosts shareholder value. Opening hundreds of new restaurants while sales are slowing can create a rebound effect. Sticking to expansion plans during a downturn will bear fruit when things turn around.
I do think that there's still a tremendous amount of white space opportunity for this brand, particularly kind of smaller markets, let's say sub 100,000 in population. I think where we continue to see higher visit per location trends, I think that's still a very fertile ground. There's still a lot of opportunity. There's still a lot of people who haven't been exposed to the Chipotle brand in those markets. So I think that's still an opportunity too.
Chipotle hit a 52-week low of 31.01 in late October 2025, and it's up over 3% since then. My model shows a value of $45.17, which is a 41.3% discount at current levels. On Wall Street, we buy with a margin of safety of at least 20%. So Chipotle is a solid buy at current levels. And if you decide to add it to your portfolio, this is what you should do. Decide how much capital you want to allocate to the position. I typically choose 10% as my max, but start small and build over time. Utilize limit buy orders so that you're not chasing the stock. Break your purchases into pieces so that you dollar cost average into the position. Chipotle is one of my favorite places to grab a quick bite because it's healthy and a great value. Despite the stock being down about 44.6% in the last year, this presents a great opportunity for patient investors. Remember, traffic is down, the company reduced guidance, and they are anticipating a few rough quarters. Management has stated that things should turn around in the second half of next year, so be patient and it will pay off. If you like this and want to see another in-depth stock valuation, check out my Tesla video here or my Adobe video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.